This video is educational. It is not tax or legal advice. Tax rules are detailed and fact-specific. If you are not confident about your situation, you should work with a qualified tax professional, especially if you have large balances, multiple accounts, or a mix of pre-tax and after-tax money. Let us start with what a backdoor Roth IRA is. The backdoor Roth is not a special account. It is a two-step process that uses existing rules. Step 1 is you make a non-deductible contribution to a traditional IRA. Step 2 is you convert that traditional IRA to a Roth IRA. People use this when their income is too high to contribute directly to a Roth IRA, or when they want Roth money and they are comfortable paying any tax that comes with the conversion. The words sound simple: contribute, then convert. But the tax outcome depends on one core concept: basis. Basis is your after-tax money inside traditional IRAs. If you contribute non-deductible dollars, those dollars create basis, and the IRS expects you to track basis on Form 8606. The purpose of the backdoor approach is to create basis and then convert that basis quickly, so the conversion is mostly non-taxable. Mostly is the key word, because the pro-rata rule can cause part of the conversion to be taxable even when you believe you only converted after-tax dollars. Before the step-by-step, I want to set expectations. A clean backdoor Roth is easiest when you have zero pre-tax IRA money on December 31 of the year you convert. When you have no traditional IRA, no rollover IRA, no set IRA, and no simple IRA balances at year end. That is the clean slate scenario. If you have pre-tax IRA money at year end, the pro-rata rule will blend your after-tax and pre-tax money, and you will pay tax on part of the conversion. Maybe a small part, maybe a large part, depending on the size of the pre-tax balance. Now, what accounts matter for the pro-rata rule? The pro-rata calculation looks at the total value of all your traditional IRAs, rollover IRAs, set IRAs, and simple IRAs combined. It generally does not include 400 plans, 403 plans, 457 plans, and it generally does not include Roth IRAs, but it does include those IRAs even if they are at different brokerages. Even if you mentally label one as the backdoor IRA and another as your old rollover IRA, the IRS treats them as one combined bucket for this rule. Also, timing matters in a way that surprises people. You can contribute in January, convert in January, and still get hit by the pro-rata rule if you have pre-tax IRA money on December 31 of that same year. The year-end snapshot matters, not the balance on the day you convert. With that foundation, here is the clean step-by-step process. I will go slowly and call out the details that help avoid paperwork problems. Step 1. Confirm you are a good candidate for the backdoor Roth. That means you have earned income for the year at least equal to your planned contribution, and you understand that you are making a non-deductible traditional IRA contribution, and you understand that conversions are not limited by income, and you are prepared to handle any tax impact, ideally minimal tax impact if you have a clean slate, but you still need to be prepared. Step 2. Check your IRA landscape before you do anything. Open a list and write down every IRA you have anywhere. Traditional IRA, rollover IRA, set IRA, simple IRA, inherited IRA, and Roth IRA. Inherited IRAs have special rules and generally are not used for the backdoor mechanics, but you still want to know they exist. The key for pro-rata is traditional, rollover, set, and simple. If the combined pre-tax value of those accounts is not zero at year end, the pro-rata rule is in play. Step 3. Decide where you want the transaction to happen. Many people use the same brokerage for the traditional IRA and Roth IRA to make the conversion simple. You can do it across different firms, but it adds friction and increases the chance of delays that create accidental gains or administrative errors. Choose a brokerage you trust, with low friction conversions and clean tax reporting. Step 4. Open a traditional IRA. If you do not have one at that brokerage, you can open it with a zero balance. This is the staging account for the contribution. Step 5. Open a Roth IRA if you do not have one. This is where the money will land after conversion. Step 6. Make the non-deductible contribution to the traditional IRA. Contribute up to the annual limit allowed for your age. The limit changes over time, so confirm the current number for the tax year you are contributing for. You can usually make a prior year contribution up until the tax filing deadline, but the conversion step is reported in the calendar year it happens, so be careful about mixing years. We will talk about that later. When you contribute, you have a choice. You can contribute cash and leave it in cash, or invest it immediately. For a clean backdoor Roth, most people leave it in cash or a money market fund for a short period, then convert. The reason is simple. Any growth between contribution and conversion is taxable on conversion, and any loss complicates the story and can create small basis tracking issues. The cleanest path is minimal market movement between steps. Step 7. Wait for the contribution to settle. This is not a tax rule. It is an operational rule. Many brokerages will not allow a conversion until the contribution is settled. Settlement can take a day or several days. Do not rush by using margin or other features. Keep it simple. Step 8. Convert from traditional IRA to Roth IRA. Do a Roth conversion for the contributed amount. In a clean slate scenario, you convert the full balance of the traditional IRA. If it is the same amount you contributed and there was no growth, your taxable amount should be near zero. The brokerage will issue a Form 1099-R for the conversion, and you will report the conversion on Form 8606 with your tax return. Step 9. Invest inside the Roth IRA based on your strategy. Once money is in the Roth IRA, you can invest without worrying about taxable conversions later. Roth growth and qualified withdrawals can be tax-free if you follow the rules, so the Roth is valuable long-term space. Step 10. Complete the tax reporting correctly. This is where many backdoor Roth attempts fail, not because the steps were wrong, but because the forms were completed incorrectly. The core tax form for a backdoor Roth is Form 8606. It tracks non-deductible traditional IRA contributions and it calculates the taxable and non-taxable portion of conversions. You will also receive a Form 5400